Okay, as I covered in my opening editorial, housing affordability is a huge issue right now. One group who have a private sector solution is Home Affordability Solutions. I'm joined now by its CEO, Beth Comino. Beth, welcome to Bernardi. Thank you for joining me. What does Home Affordability Solutions provide for aspiring homeowners?
Hi Corey, thank you so much for having me today. Home Affordability, or HAS as we call it, is a mortgage manager that specialises in shared equity. Now, shared equity has been extensively used in the UK and in some states within Australia as well, with some great success. Basically, shared equity allows for lower monthly repayments in return for a share of the capital growth. Our aim at Home Affordability is to try and help you get into the property market now, rather than waiting 11 years to save that deposit, which you need 20% deposit to get into the property market to avoid any lender's mortgage insurance. We've got 4 objectives at Home Affordability Solutions, being the homeowner has 100% ownership of the property. You get into the property market with a 2.5% deposit only. We're wanting to mitigate the risk between parents helping their kids get into the property market as well. And we're providing lower mortgage servicing for the homeowner, especially in that first 5 years, to really establish themselves. So not only get them into the property market, but help themselves establish and get themselves into a better position financially.
All right, that all sounds fantastic, but how does it actually work in practice? If someone wants to buy a property, their first property, they come to you, what's expected of them? How does it work?
Yeah, sure. So it's a standard loan process. Basically, the client or the customer, the homeowner, is looking for a property, and they come and they do a 30-year loan application, which is a shared equity loan application. Now, all they need is a 2.5% deposit, which I touched on before, and then we do a split. So there's an 80% standard mortgage, which you would get the standard 80% interest rates, and then we come in with that 17.5% shared equity, which is that real boost into that property market. So with a 2.5%, you're avoiding LMI because we come in with that 17.5%. On the shared equity facility, that's where the difference really comes in. So our interest rates are 3.25% fixed, interest only for 5 years, so that's rent that we collect on that. In the 6th year, it increases by CPI. So if you're sitting in a 30-year facility, you're doing interest only for 5 years, and then CPI increases from year 6 to year 30. But if you're looking at a CPI increase, you're looking at a very marginal interest rate rise. So say from that 3.25 to a 3.4%. Really, we also include 3 years of repayments in the shared equity facility itself. So that's for the shared equity facility. So the mortgage holder is only making repayments on that first mortgage, that 80% for the first 3 years. Now, with the parents themselves, I mentioned that we're trying to mitigate the risk between the parents and the child, helping them get into the property market. Now, the way that that works right now is with a family guarantor or a gift. Now, with a family guarantor, you're having to do a second mortgage or put the risk on your own property. And if anything happens to that child's property, you're linked with that directly. Now, our equity funding partner is a public property trust where the parents can actually invest in that and they get a return on the entire portfolio. Now, there's currently...
Beth,
yeah,
Sorry, this is one of the things that I find fascinating. The parents can invest, but they can use their superannuation money to get into
Absolutely.
that portfolio fund. So, in effect, their super can support a deposit or a co-equity, a co-ownership process for their children.
Yeah, that's right. Now, home affordability is not involved in the investment part, so that is definitely with the property trust itself. But because it is a public property trust, it has opened up the ability for superannuation to be an appropriate investment. Now, however that investment is made is entirely up to that individual. So mum and dad, if they're investing within the trust, they would need to get financial advice and make sure that it is an appropriate investment for them. But yes, ultimately you can invest in superannuation if it is a suitable investment for you.
Yeah, and that's been one of the perennial debates in politics. Hey, quickly before I let you go, Beth, what about existing homeowners? I mean, they're struggling under the weight of rising mortgage costs. You mentioned you've got a fixed rate product out there at 3.25% in the co-ownership. Does that apply to them as well? Is there that potential there?
Absolutely. I mean, shared equity is generally used to get into the property market, but what we've found with the crisis at hand right now, refinancing into shared equity is just softening that blow for them. So you've got 40% of mortgage holders right now that are under that mortgage stress. So rather than refinancing your entire facility into one to get a lower interest rate, you're dividing that into two facilities. So entering into that shared equity facility, we've covered those first 3 years repayments for the shared equity facility as well. So it's just allowing that time to reset for that next 3 years, just while interest rates are uncertain. We're likely to see another 2 interest rate rises this year, I believe, but it's getting harder for people, and their choices right now are looking for additional jobs or finding tenants or selling the property. And if they sell the property, they're in a strained rental market, which means they're back home with mum and dad.
Yeah, we need alternative solutions. I'm a big one that private sector is doing it much better than government, and I think you've confirmed that for me tonight. Beth Comino, thank you so much for your time. I really appreciate it.